Torsten, it is fantastic to see you here, even if we don't have the jobs data to talk about here today. Before we sort of dig into the big picture, I'm curious if you have any first blush reaction to the ISM services number that we just got, considering it came in a little bit weaker than estimated at 50.
Yeah, what's interesting about what just came out is that, yes, the headline number was a bit weak, but at the same time, prices paid, meaning what are service sector companies paying for inputs into their production, actually went up. And at the same time, you also saw employment actually also went up. So this is telling you that maybe the inflationary pressures that are the biggest worry and has been the biggest worry in many FOMC mentors' speeches are beginning to show more signs of life, meaning that there are more risks still to the upside in service sector inflation. Because for a long time, the story has been very simple, that tariffs are mainly on goods. That's why goods inflation has been going up. But now the data that just came out suggests that we should still be watching very carefully what's going on with inflation in services, because now service sector inflation is going up. And remember, services makes up 60% of the CPI index, goods makes up 40% of the CPI index. So the higher rise in service sector inflation we just got right now a few minutes ago is suggesting that maybe inflation is going to be more sticky and more elevated.
It's also intriguing to me in this ISM report that the employment index coming in at 47.2, which is below 50, but still a little bit of an improvement. Given that we don't have the BLS data, I mean, how much importance should we put on that number, and what is that telling you?
No, this is very important because we are really flying in darkness at the moment, because the government data is absolutely of the highest quality relative to any private sector data. The challenge, of course, is that today we didn't get non-farm payrolls. We didn't get one side of the Fed's dual mandate, namely employment. And if this continues into the next several weeks, we will also not get inflation. And that makes it very difficult for the Fed when they meet on October the 29th, because then they need to make a decision without knowing the two very most important variables, namely what's going on with inflation and what's going on with employment. So the answer, Julie, to your question here is that it is indeed challenging for markets to figure out what is the true state of the economy when we don't have the highest quality data that we all normally spend so much time on.
Well, we might not have the highest quality data, but we have an awful lot of data that is out there. And you recently came out with a sort of assessment, right? You listed a lot of the other data sources. You tried to figure out, okay, which are the ones we should be watching. What did you come up with? What are you going to be watching most closely in the absence of getting stuff from BLS?
Yeah, this is also very important for investors at the moment, because if we don't get the government data, then exactly as you're saying, we need then to look, of course, elsewhere. And what are other data sources to look at? Well, one very important indicator is the Red Book same-store retail sales. So this is weekly data that measures what was retail sales last week relative to the same week a year ago. So that's telling you what were sales at Walmart, TJ Maxx, Target over the last week. So this is already a good indicator because it comes out every week, every Tuesday at 9 a.m. and tells you something about the health of the consumer. Other indicators, of course, are Open Table has daily data for how many people go to restaurants. You also have weekly data for how many people go to hotels. This comes from Star, a company in Texas. They report what is RevPAR, what is daily rate, what are occupancy rates across hotels across the country. So there is a broad range of indicators that you can also look at, including, of course, ADP, which we got earlier this week for the labor market, that will give you some idea about how the economy is doing. And these indicators are not perfect, but if you take them all together and put at the mosaic and the picture that they paint, we'll still give you some good idea about what is the direction that the economy is flying in at the moment.
Okay, so tell me then, given all of that, and given the government data just stopped, right, a few days ago. So what's your assessment, Torsten, overall? And I ask that even as you pointed out in one of your recent daily sparks, economists have to sort of take a good look in the mirror here, because not just this year, but for the past several years, your profession has been predicting some slowdowns that have not necessarily arrived.
And that is absolutely correct. And in particular now, we are literally today 6 months away from Liberation Day. And often you hear the forecast that, well, we're just waiting for the delayed negative effects of the trade war. Okay, now we are 6 months in. and we're still waiting. I mean, maybe Godot will not arrive, and maybe we will not have that slowdown that we all expected was coming as a result of what happened in April and May, where things, of course, were very turbulent. So maybe we should begin to come to the conclusion that maybe we're not going to see the economy slow down. And what's the consequence of this? Well, the consequence of this is that at the same time, we have upward pressure on inflation from tariffs. We have upward pressure on inflation from a lower dollar. Remember, when the dollar goes down, it becomes more expensive to buy my white shirt abroad. And if that's the case, then the price of my white shirt will go up. So that means that we have also inflationary pressure because of the depreciation of the dollar we have seen. And we also have inflationary pressures because of immigration restrictions. Deportations and immigration restrictions means that wage growth is starting to rise, especially in the sectors where unauthorized immigrants are concentrated, namely hotels, restaurants, agriculture, and construction. So taking these things together, if we already have from the consensus a forecast where the expectation from the consensus is that inflation will be 3% for the next 12 months, remember it's supposed to be 2% according to the Fed, that just brings down the conclusion, well, okay, if we at the same time do not have an economy that's slowing down, that means that the upside risk to inflation is even bigger. So in summary, the short answer to your question is, if we turn out to be wrong in the economics profession and the economy is actually not slowing down, well, then I will worry even more about inflation going up, and therefore that the Fed should therefore really begin to think more about rate hikes and worrying about inflation being sticky and not coming down as significantly as they have currently in their long-term forecast.
So let's just look real short term then. Do you think that the Fed, I guess it's a two-part question, will cut rates in late October, and do you think they should cut rates in late October?
I think they will cut rates, but I think we're getting to the point where we need to look very carefully at the inflation outlook. I understand, of course, service sector inflation for a long time was going down, but in the last 3 months, it's actually started to move sideways at around 4%. Goods inflation, that has certainly started to move higher, partly because of tariffs, partly because of the dollar going down. So when we put together our Apollo forecast for inflation, goods inflation is certainly moving higher. Partly because of tariffs, because inflation is measured year over year. That means that year over year, inflation will be rising. Service sector inflation, in what we just saw that came out here a few minutes ago, you are beginning to see more upward pressure on ISM services prices paid, which is also telling you that maybe there's a risk even to the upside also for services inflation. So that means that both goods inflation is at risk of rising, and now we're seeing here at 10 a.m. a few minutes ago that service sector inflation is also rising. That brings me to the conclusion that maybe in October, it would be a good time to pause and have a careful look at what are the alternative indicators for inflation telling us at the moment.
Well, and Torsten, let me ask you this as well. As you know, consumer spending has been incredibly resilient this year, even with all of the, sort of headlines and headline risk. What have we seen in the, if inflation is going to be persistent, does that feed back through and depress consumer spending?
Yeah, because the real challenge, of course, is that if inflation starts to stay higher for longer, that is not only the Apollo forecast, that is also the consensus forecast, that is actually also the Fed's own forecast. It has exactly two consequences. Number one is indeed that then, of course, consumers will find prices higher. That will have impacts, of course, on real spending, meaning how much people will be buying. Walmart said this through this earnings season. Well, meaning with the one we had in Q2, we are going to raise prices. And at the same time, of course, we should expect that we're going to see lower sales. So a very important first conclusion is that this will indeed impact consumers, especially more price-sensitive consumers. The other added effect, of course, is that if inflation is higher for longer, that interest rates will also stay higher for longer. And that means that it will still continue to be more expensive to borrow on your credit card, more expensive to borrow on your auto loan. And as a result, we have already seen delinquency rates rise since the Fed began to raise interest rates in 2022. So we are already seeing people falling behind on credit card payments. We're already seeing people fall behind on auto loan payments. And if inflation now is higher for longer, it's just going to take longer before we begin to see some improvement in the delinquency rates across different types of consumer credit. So the short answer to your question is consumers are hit partly by higher prices, which is the direct impact, but also by the indirect effect that the Fed will have to raise interest or keep interest rates at higher levels for longer to make sure that inflation does come down to the 2% that they have been mandated to hit by Congress.
As we know, Torsten, there's been an offsetting effect in the market from all of these sort of economic cross currents, and that's AI, which has sort of like swept away everything else. You've written a lot about AI, its contribution to GDP, but also market concentration in AI companies. And it's just getting more concentrated. The market's going, yes, there's been a little broadening, but it's still very concentrated here. So what most concerns you about the AI cycle at this point?
Yeah, Julie, and I know you have covered this so extremely well because this continues to be a very important backdrop for the macroeconomic conversation, namely, what does it mean for investing? And when we think about the macroeconomic backdrop, all of us, of course, we immediately begin to say, well, if the economy is accelerating or decelerating, how should I think about the outlook for the S&P 500? But what is absolutely critical in between that discussion is exactly this issue that essentially the AI story now makes up 35% of the S&P 500. The 10 biggest stocks make up almost 40% of the overall S&P. At the same time, earnings have been highly concentrated in the Magnificent Seven. You also have had CapEx spending, including data center spending, has been very concentrated among the Magnificent Seven. You also have returns across the board. The S&P 500 is simply no longer the diversified investment that it used to be because the AI story is so pronounced. And with some of the recent developments, including in the census bi-weekly survey of more than 1 million US companies and asking them, what is your adoption rate? Have you over the last 2 weeks adopted AI? You're beginning to see to this question where companies are asked, have you adopted large language models? Have you adopted voice transcription? Have you adopted readings of documents? And those different types of questions, in particular larger companies, are now beginning to say, you know what? Our adoption rate of AI has begun to slow down. So the real risk to the economic outlook is if the AI story starts to fade, if it is a worry here, which it is for many, including me, that maybe a lot of AI companies are indeed overvalued, then it would begin to have some significant risk when we think about the S&P 500. That is different for the S&P 493, but it certainly means that there's a very, very high concentration in the AI story that's driving the stock market forward, which, to your point, is exactly somewhat disconnected from what's going on in the economic outlook.
Torsten, we'll keep watching to see how that AI story plays out. Great to catch up with you. Thanks so much.
Thank you.